Hey, everybody, welcome to the Multifamily Legacy Podcast. I'm your host, Corey Peterson. Got a great show for you today. We're going to talk about banking and lending and getting some fat cash, stacks of cash from the cheapest place that I know how to find it. And I'm going to introduce my good friend, Aaron Moll. Now, Aaron has been in the finance business getting loans for people for over 10 years, and he's been at Berkadia, where they're a full dust lender. They really do everything. When it talks about lending, I think you do the whole spectrum, don't you, Aaron?
That's
He's
absolutely
done
right, Corey. Good to be
he's
here.
done over $1 billion in loans, and he does specialize a little bit in student housing loans, and that's something we've been doing a really lot of. And he's actually helped me get the two student housing loans that I have. Actually, I have a total of three, but he's helped me get two. And so, Aaron, welcome to the show, brother.
Thanks, Corey. Good to be here. Always good seeing you, my friend. Always good talking with you.
Yeah. So let's kind of jump into the world of banking and getting loans for like these bigger deals. And maybe we just start with like what is out there. Like, so in the realm of like agency, non-agency, take it away, man. Just give us a
Absolutely.
little.
Yeah, yeah, we'll do it.
Tell us what you know.
We'll start on the surface and then just dive as deep as you want to go.
Okay.
Yeah, so to kind of give a holistic approach to debt lending, multifamily financing specifically, we'll just stick on the multifamily. You on your perm space, which permanent debt, you've got agency, Fannie, Freddie, and HUD. You've got Lifeco, which is a variety of different life insurance companies out there that are looking for low leverage, cheap debt, kind of the best interest rates in the market. CMBS, which acts a lot like a Fannie-Freddie without the government guarantee, and then bank and bridge. So with the bank and bridge, you've also got some debt funds, most of your Wall Street financial institutions, things like that. So here at Berkadia, we rep all of those. I'm fortunate enough to have kind of all the tools in the toolbox, which is helpful for folks like Kahuna and yourself, getting deals done. We're going to talk about a case study where we had to be quick on our feet and kind of use a couple of those tools. But primarily what I work on, and if you stick on the student niche, is Fannie Freddie. They tend to kind of lead the pack when it comes to permanent financing, and there's various different reasons for that. But yeah, they've been pretty active. So that's kind of what's out there, and we can go into each of those if you like.
Well, yeah. Let's just talk about. So, what's some of the differences? So, let's just talk about agency versus we'll call it CMBS, right? So, um, yeah, saying some of the lending policies on one versus the other. Like, yeah, let's put them up against each other.
Absolutely. So again, Fannie Freddie, kind of the king and queen of multifamily. If you're a masochist, we have HUD loans for you as well. If you like long-term debt. So to kind of start with Fannie and Freddie, because they do act a lot like the same. Very good lender for permanent debt. Most deals are done on 10-year fixed, 30-year amortization with a little bit of interest only if you like to do that. They're best suited for higher leverage transactions. Good example of that, if you're buying a multifamily property, a lot of times we can get you 80% loan to value, non-recourse, 10-year term, 30-year amortization with a little bit of interest only, and pretty competitive rate. If you're wanting to go longer term, HUD's a great option. You can do a 35-35, or on new construction, a 40-40. Again, it's just a longer process. So Fannie Freddie, very good on acquisition financing, very good on refinance. And the biggest difference, Corey, that I always say, and kind of the biggest pitch with Fannie Freddie versus the CMBS transaction, is your supplemental capability. So what I mean
So
by
yes,
that,
that's right. Yes, yeah, attaboy.
oh yeah, you know where I'm going with this. So
Yep.
that's probably the biggest advantage that they have. And what that means, supplemental financing. Let's say we give you a 10-year term, brand new deal that you're buying, a little bit of value add to that deal. You're going to go in at say an 80% LTV at, call it, a $10 million loan. You do a nice job, you have some value add in the property, NOI goes up a little bit over the next 2-3 years. If you got a capital event, you got a CapEx project, or you just want to pull some more equity off the table, Fannie Freddie give you programmatically supplemental loans. You get one more bite at the apple during your 10-year term. So in year 3, call it, you can go back to us and say, hey, here's my updated underwriting. Where are my proceeds sizing? We may be able to get you another $1 million to $3 million out of that project, going back up to an 80% LTV on the new loan to value at that time. So it's a great opportunity to go back, grab some more equity off the table, cash yourself out a little bit more. And if we want to get into the minutia a little bit, the way that spreads is it's a coterminous loan, meaning it's going to mature at the same time that your A note matures, and they add just a little bit of spread. So your majority of your proceeds at that $10 million are still locked, and that, say, $2 million supplemental is priced just at market with a little bit of premium for the sub.
So let's break that down, because like this is why that's really important. So with what I teach how to do, right? So you're always looking for the exit. Like when you do apartment deals and you have equity involved, and you're syndicating like I am, it's always about the exit, right? So that's really should be your focus, is how do I exit this money at the right time? And
right.
So that supplemental is a way. So we typically hold our deals for 5 years, and then we're going to want to do a supplemental. And the reason for that's that supplemental loan is to take out to my capital, which then will still allow me to own the deal 100%.
Yep.
And that's a big deal. So this is my favorite play if I can, right? But it doesn't always go that way, right? So not every deal lends itself to Freddie, because they have guidelines and rules, right?
Yep.
And so they also have review markets and non-review markets.
Yeah, you're going to get, and that's probably more your small balance loan, Corey, is yes, the lender always wants to know what the real estate looks like. The lenders that I'm referring to here, the Life Cos, the CMBS, the Fannie-Freddie, we're talking non-recourse, right?
Yep.
So the folks that are used to dealing with their banks, they're usually signing on those loans personally.
Yep.
And what that means for the lender is, I don't care as much about the real estate. I've got a personal guarantee. So if stuff hits the fan, I've got somebody I can go after. My lenders are all non-recourse primarily, meaning we got to dive into the real estate a little bit more. It's really the only collateral that they have, right? So if you've got a small market, and what you hit on was like the pre-review markets and things of that nature, there's a loan program called Small Balance Loan. It's really dedicated in the Fannie-Freddie world to streamline the whole process, to clean up the closing costs. It's low cost transaction. It's an expedited transaction, really designated for $5 million loans and under.
Yeah.
And they do have some rules because it's a box, right? They want to get the loans closed quickly.
Yep.
Where the borrower really benefits on those is it's $13,000 to close that loan with all third-party reports, legal.
It's a super cheap way to do a deal if you have anything under $5 million, and it's a really nice deal, right? But sometimes, so I'll give you an example. We'll talk about Eagle Village a little bit, right? So Eagle Village was a deal that we did maybe almost 2 years ago.
Yeah, it's been that long.
It's coming on. It's not.
We're going to be talking. We're going to be talking in 3 more years when that deal matures.
Yeah. So, and by the way, we've crushed it on this deal. So we bought a deal that was 88% occupancy. Well, I want to say that 88% occupancy was one of our barriers to entry to get a Fannie debt. Am I right?
Yes.
Yeah. So
yeah. Go ahead.
Well, those deals go ahead. I'll shut up.
You and I we're both outgoing. I was gonna say we wanted to go Fannie-Freddie with that one. That's how we started our discussions, how we met on that deal. And what we found is, again, one of the good things with Berkadia is I go to the whole market. I'm not just, unless you tell me you only want to see Fannie-Freddie, we've got CMBS, we've got other players. And what we were able to do on that is just bring you a better opportunity on a CMBS execution because the 5-year, because of the IO, and because of that market, Argenta just happened to be the winner on that one.
Right. But the other part of that was I didn't have any experience, right? So I didn't have any student housing owner experience, which was going to also kick it out of Fannie's little their box, right? So once I got kicked out of their box, I didn't have enough experience as an operator in student housing. Well, then you got to say, well, what's my other options, right? And so by far and away, though, so in my mind, best options are Fannie and Freddie. Also, what I love about them is they usually have a step down in the fee structure.
That's right.
You want to talk about that?
Yeah. So again, I think the best way to describe these is to compare the different programs.
Yeah, because we're
Let me
going to
just
go to CMBS, right?
Yeah, I want to hit on CMBS real quick because what you're getting at, I think, is a good segue. CMBS, much like Fannie-Freddie, 10-year deal, 30-year amortization. The main difference is you're not really getting off of that much these days. The way that the deal's priced, the way that they're able to offer those and securitize them in the market when they sell those deals, it's a 1030. There's not a lot of prepay flexibility. In fact, there's like none. And the 7-year doesn't price as well. The 5-year doesn't price as well. It's kind of a one product offering when it comes to CMBS execution. Fannie-Freddie, it's a la carte. You can tell me, I want a 7-year deal fixed. I want a 7-year floater. I want a 12-year fixed, 20-year fixed. We can price that option for you. And then if we go to like Corey, what you want to do is exit in 5 years. Hey, we can give you some flexible prepayment, a step down, a yield maintenance plus 50 basis points. Tell me what your goal is. We'll price that accordingly. We'll make a loan that fits your needs.
Yep. So in my case, what I was wanting when we first had talked this loan is I like some type of step down where it goes 5, 4, 3, 2, 1, 1, 1, and that's the exit in percentage points of fees, right? And that's what I like to do, but it's not always the case. And of course, once I didn't have experience, I was totally out of the box. So now, because I want to be able to exit in 5 years. Or at least have the ability, because truly my goal is to refinance and keep the asset, right? But I just got to have a way to do it. So that option wasn't on the table with Eagle Village now. So our only real option was CMBS loan, right? And which we found a good product. We found a 10-year product. Now the only challenge with CMBS is now they have what's called defeasance. So let's talk about defeasance.
Oh yeah, now we get into the fun stuff. So standard prepayment on permanent debt is defeasance or yield maintenance. Both act pretty similar. And what you're going to see there is Fannie-Freddie, CMBS, they securitize the deal, or what I mean by that is they sell it as a bond to an investor. The investor wants to get made whole, right? So on defeasance, if you defease a deal, call it or an example would be you want to pay off a deal in year 5 on a 10-year note, you need to continue to make those payments to that bondholder for the duration of the deal that you signed up. So you hire a defeasance company to essentially make your debt service payments for you for the remaining 5 years or make whole. Now, where it gets a little complicated is the market moves around, right? So let's say, Corey, let's just assume, I don't remember the interest rate. Let's say we did a 4.25 rate or something like that on Eagle Village. If the 10-year treasury goes up and you want to defease in year 5, well, guess what? They're going to able to take your principal payment, make more money on it because the 10 years increased, and your defeasance calculation is going to go down. So the simple way to put that is if the interest rates go up, defeasance goes down. If interest rates go down, your defeasance cost goes up. It's a moving ball, and it's just determined at the time of payoff.
Yeah. So in my example of Eagle Village, like when we have a 10-year note. In 5 years, we plan on doing some type of exit. We'll probably actually do a refi, right? And we will probably refi with a Freddie or Fannie loan. Maybe, because this might be a legacy property, we may do a HUD, right? Because it's a really nice property. I'm in it really well, and so it may make sense. The problem with that HUD loans take like 6 months to do.
They do. The juice is kind of worth the squeeze, right? I mean, you need to. It's some red tape. It's some paperwork to get those done. Just a little shameless plug. Berkadia is the #1 HUD lender in the country. I do think you need a good partner when you do a HUD loan because we want to we want to make sure it's as easy as possible for you. We do a lot of the paperwork for you and have you just sign. So yeah, we're knocking out refis anywhere between 4 and 6 months. Where Fannie-Freddie we can close in anywhere between 30 and 60 days. A little bit easier to get done. But on the HUD side of things, so just talking about, prepayment flexibility in the loan product itself, HUD is going to have an extremely low interest rate. If you refi, let's say Eagle Village, that rate today on a 35 is below 4%. And it's 35 years fixed on a 35-year amortization, non-recourse. It is a very, very good loan. So where, what's the downfall? What are the cons? A little bit of extra cost. You got to have audited financial statements each year. You have what we call REAC reports when people are inspecting the property each year. So you got some upkeep. But again, is the juice worth the squeeze if it's a good loan product for you. What we find is a lot of people do one HUD loan, they get those instruments in place, and they just keep on doing it because they've already got the infrastructure. Now on prepay, you mentioned 5, 4, 3, 2, 1 step down. It's a 10-year step down. So you see 10, 9, 8, 7, 6, 5, 4, 3, 2, 1 on a 35, 35, or you have open prepay starting in year 11.
Yep. So it's, HUD's really a good option for when you have like a legacy asset, right? So this student housing, for me, it's 2006 vintage. It's a newer building. It cash flows amazingly well. And once I exit my capital and I just own it myself, I am going to really want to put that into play as a legacy HUD asset. Give me a low payment. I don't plan on selling it. I don't need the money out of it. I'm not trying to extract. But I may prolong that. I may do just a regular Fannie or something to pull out as much equity as I can. Can I pull out equity in the HUD or no?
Absolutely. Yeah, it's a sizing to a and the other nice part with HUD is it's an 85% LTV.
Okay.
So they'll actually go higher on leverage. They do have some reserves in that, so it's a little bit of juju math. But
so I will probably. So then that's probably what I will do. Then we'll resize that to as much as we can. Pull out. We'll still have equity in the deal. That's fine because we're buying it mainly for cash flow, and that's like forever cash. Like that thing will always make money. We would be hard pressed to screw it up. And
right.
So,
I love it.
Yeah.
We're strategizing on Eagle Village as we speak.
Yeah, we already are, right? So and the great thing about that is like think about where we're at in this deal. We already know it's performing, it's doing really well. But when you're not in a position like so we already own the asset, it's easy to plan then, a year when you get to that last year when you're going to refi or start the process when it makes sense. It's very easy to then say, okay, well, here's, so what if it takes 6 months? Who cares? We'll just start the process.
You don't have for lack of a better phrase, you don't have a gun to your head. It's not an acquisition, right? We can slow roll refi. We can start the process early. I'm with you. Now, HUD works for acquisition as well. So if you got a deal that you want to buy and you're looking for some higher leverage, long-term hold, want the 35-35, we've got a proprietary bridge group and we've got other bridge groups that can close you in the 30 to 60 days, get you done, do a short-term bridge. It would be an IO payment, still non-recourse. And then we're working the HUD refi during that time. We get you in the HUD loan 6 months later.
Yep. Now, so for me, for a syndicator, that typically doesn't work unless it was my own. Like, so if I sold the property and I had a bunch of my own money going into a new deal, like I wanted to exchange my own money into a deal, then that would make if I had a smoking deal that I knew it was another legacy asset, that'd be a great way to segue that. The only reason is because typically in 5 years I want to out. Well, that's going to cost me more money on a HUD than it would be like agency Freddie Fannie, right?
Yeah. Sometimes there's some peace of mind just knowing what your prepay is going to be, right? If the plan is to maybe not sell in 5 years but hold or something along those lines, you at least know in year 5 your prepayment is going to be 5% of your principal versus a defeasance where you just don't know, and a lot of times it's more than 5%.
Yeah. And so now, and here's the other part of this, like, notice how important, okay, we're already just right now talking about Eagle Village, like it's because it's in play, right? And so me and him are just talking about other things, right? And so that's how it works with a mortgage broker. This is why it's so important to have one on your team that knows everything that's out there. You don't want just the guy that has one product. That's like suicide, right? You just don't do it. You want someone that represents the whole gambit, because then they can say, it really is, Aaron does a really good job of this. Corey, what's your goal? What do you want to do so that I can go out to the marketplace and find something that fits? That's a big difference, right? In my mind, I mean, I think that's what you do best.
Yeah, absolutely. Yeah, it's we deal with a lot of folks that are getting into real estate, been in real estate for a little while, and just dealing with their banks, and that's fine. Local banks you need them for construction loans, you need them for a variety of different things, but it's great to get to know somebody, reduce their contingent liabilities, and just talk about the deal. Corey, I'm sure you agree, every deal in your portfolio is vastly different from one another. Real estate's different, right? Your
Yeah.
loan should not be the same on every single deal. Every deal acts differently, and there should be different plans of action, execution, hold periods, you name it. So we try to marry up the debt to best secure cash returns. That's what everybody's in this game for, to make some money. So, we're all selling the same color money. We're just a commodity business, but the way that we can structure and execute it, a lot of times it's better off one way than another.
Well, and not all lenders are the same. I mean, like, it's really about, because now let's go to the next piece, which is bridge, right? Because you just
Oh yeah.
mentioned it. So bridge is a little bit more like who you know, right? What
Yep.
bridge lenders do you know, and what, yeah. So let's talk about
Yeah,
that.
Bridge is fun. Bridge is, I absolutely love my Fannie and Freddie. They keep the lights on for me. It's the vast majority of what I do. But bridge is fun. It keeps us nimble. Listen, so update on the bridge market. It's a very competitive space. We have absolutely over 100 lenders in this space right now, trying to get multifamily, trying to find that deal that you need to close quick, or you're buying it. It's low occupancy. You got a CapEx slug that you're going to put into it. It's not ready for a Fannie-Freddie. We're going to talk about a case study here in a minute, that, you can put a short-term loan on that. These lenders will fund your CapEx, pari passu. So, like, to give you an example, let's say you got a deal that you want to buy for 10 million bucks. It's 85% occupied. You want to put maybe 3,000 a unit into that property, get it up to stabilization, and then either sell it or refi it. Fantastic bridge opportunity. We'll see lenders go up to 85% of purchase price on those. Cash flow, I don't want to say is irrelevant, but it's not a stop. We can go below a 1.0 DCR. We can go to a deal that doesn't cash flow day one and structure that. And then on that, 3,000 a unit, they'll fund that at 85% with you. So it's a great partnership program. Oh, and by the way, it's non-recourse and it's an interest-only payment. So
Yes.
it's a very competitive space, and we're doing a lot of that business.
Yeah, so that's really a great way to transition property. So now that we've kind of got there, let's talk about Hawkeye Towers,
Great.
right? So Hawkeye Towers is a property in Waterloo, Iowa. That's a student housing project. Now the problem with Waterloo, Iowa, is Waterloo, Iowa. Okay, it's a small tertiary market, but it's the biggest city in a 150-mile radius.
Right.
But it's not very attractive to Freddie and Fannie, right? But they will probably buy it, right? You actually got them to say yes.
We were about done on a Fannie execution on that deal. And just a real quick comment on student housing specifically. I travel a lot. I go see all my deals that I'm financing, and it's student is great, but they're always in small towns. Right?
Right.
It's usually required. Tuscaloosa is not a big city, right? And it usually got to fly to Atlanta and drive over. So, Fannie Freddie absolutely, when they look at student housing, they're looking more at that student size and the enrollment
Yep.
size of the market than they are the size of the MSA. However, Corey, you're right on. It's a market search. In Waterloo, Iowa is Hawkeye Community College, so it is not.
Yeah, it was a community college, right? So
like tier one. However, we were able to get Fannie on board. We got them comfortable with you. We got them comfortable with the business plan, the execution, the deal. And in that particular case, again, we were under application with Fannie, ready to put a perm. And what happened? The deal didn't lease up. So
the seller screwed it up, right? They get seller coma. I talk about this on many podcasts. I'm telling you, sellers, you go under contract and something weird. It's like voodoo magic. Someone's got a voodoo doll and they're like, go to sleep, right? Fire all your staff, make sure they don't show up for work. And, and all of a sudden, you were 95% occupied last year, but this year you're at 88% or 84%. And now it kicked it out because you got an exception to get it at 89. Because we were right on the bubble, and they couldn't even get it to 89. And where they were previous year, they were 95.
Yeah, this is one that was, man, we tried, right? And we were right on the 1 yard line. All that needed to happen was lease up. We had underwritten a deal at, I think it was 93, but it was 95% occupied. But the target, Fannie even gave us some buffer to get to 89. He could have slipped by 6%, and I think he ended up at like 82. Fannie was hey, listen, we'll fund you the deal. They were ready to do it, but it would
Yeah.
have required such an additional cash down payment. It makes sense. So that was something where you and I, Corey, talked, and it's like, listen, we can give you this perm loan today. It does have that Fannie Mae supplemental, so you can come back and get more proceeds when you lease it back up. But probably the best execution is to do a bridge, and we'll fund you at a higher LTV going in, lease it back up, and let's talk about it next year once you correct the problem. So we'll be talking about that deal in just a few months, putting probably a Fannie Mae loan back on.
Yep, exactly. So once that deal fell through, now understand when a deal falls through like that point, it requires more money, right? Because so everybody has a process, and the Fannie one is actually not that expensive to initiate. But when you go to Bridge wants like $40,000, $50,000. I think you got an exception on this one to lower the cost because we're using the same lender that's going to get the permanent financing once we do it. But so we used now. This is why the Bridge is so sexy. And now, but here was the challenge. As we were looking for Bridge notes, it was just we had this little box that we're trying to figure out how to structure it, and it was kind of hard.
That's right. Yeah, it was. That's really where the market came in. At market size, bridge lenders wanted a little bit more cash injection. We were able to pull a rabbit out of our hat by just sticking with the same lender that had it. They've been living with it. They were comfortable with it. They were comfortable removing the recourse, which was a little bit unique because it was a local bank. But we got it done. And the way I was able to negotiate that for you is, hey, we're going to not pay you an exit fee. We're just going to bake in a little bit more interest rate so he doesn't have any exit fees. And we ran the math. It ends up being better for you because of the short-term duration of the loan.
All right, so hold on, time out. So that's what happened, but I'm gonna give you my version. So, because like I'm starting to get a little cranky at this point, right? Corey gets cranky sometimes. My job is to push, 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 right? And when I start saying "what the f," right? Because I think I said it a couple times.
Couple.
Now Aaron's still being cool the whole time, right? And we're just trying to find because we're all trying to do the same thing, which is find the solution, right? Unlock the box here because the seller screwed us and we're under contract. Our money's hard. We could probably make the argument that he, operated out of bad faith, but like it is what it is. And it's still a great deal. We just got to get it dealt and bought. So Aaron does say, she's like, hey, dude, let me just call the credit union that has the existing deal, and let me just see what's up with that. Let me see if I can work that angle. And dude, and that's what he did. And like, not really in his box, but he's a lender, and he's working hard for put this thing together. And that's exactly what you did, Aaron. You went and you took a lot of but understand, and he said it, but I want to say it again and emphasize it. The current lender that had the loan to the seller credit union had a personal guarantee. Now, credit unions and banks don't typically come off a personal guarantee ever. Like, that's a unicorn. Am I right, Aaron?
No, you're right. You're right.
That's a unicorn, man.
Especially in Waterloo, Iowa.
But Aaron, if you're watching on video YouTube right now, you see Aaron's got his head shaved, and he's Mr. Clean, and he just put the moves on him and just said, "Listen, here's what we got to have. Here's what we got to have, or we're gonna have to go somewhere else." Fear of loss, right? Because they already had the debt, and it was good debt for the credit union. They knew the asset, right?
That's right. No, you're right.
And it was one of those things where the guy, some towns, there's truly a good old boy process. And this is exactly how this town was, is the guy you were talking to he's had to go in front of his board, but he's like, basically, if I recommend it, the board's going to say yes. Right?
Yeah.
And that's what he did.
It was, yes. I mean,
they almost didn't think they needed to fund all the money. They're like, oh, we'll just send you the difference or something. We're like, no.
That was again, Waterloo, Iowa. Like, we're not going to run it through title. We're just going to refund ourselves a small tick. Whoa. No, it's a sale. You got to run you got to run some stuff through escrow. But it was a bit of a process, education process. But yeah, going back to the structure, I mean, they originally wanted Corey 1% in, 1% out. It's like,
Yep.
no, 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 no. Let's talk about that. I think they ended up taking 5 basis points, which
Yes.
if you run that and then they waived the exit fee.
No
So for
exit fee. So when I go out of this thing, there's nothing. It's so smooth, dude. It was like, and 4.1% interest.
it was a good. Oh yeah, and fixed rate.
Yeah. I mean, it was just sexy as hell, dude. It was like, ah.
It was a good day. We turned a
The-
bad situation into a good
I mean,
situation.
after that, it was, come here, Aaron. Let me put my arms around you.
I came out and visited in Phoenix after that one. It felt
So
good.
yeah, exactly. Sometimes listen, Corey's a nice guy, but Corey can get heated and emotional sometimes. But this is what I love about real estate. No one remembers that, right? Once you close and transact, any heartache or bad pill or anything that was in the deal, once you close, all sins are forgiven. Most of the time.
Right.
Most of the time.
That's
Right?
why I'm Mr. Clean. Let me be the Pepto Bismol. My hair falls out and try to make your life easier.
My hair's coming, bro. I'm not far behind.
Yeah, it was a
but
good one.
but like, I guess at the end of the day, what I want my listeners to understand is that having a really a person on your team that has knowledge, and not just a little, but in depth knowledge of all the real products out there in the commercial world. It is a big boys game, and you need someone that can represent you. And part of what Aaron was doing was selling me as well to the credit union. You know, and be able, because he had his stuff lined up. It was a lot easier sell to say this guy's got this. We have a plan in place. All that stuff, right? It makes
Relationships are huge. I sit here in the middle. I got two sides of the fence, right? Corey, you're frankly more important than the lenders, but I've got two relationships to keep in mind here. I've got Fannie and Freddie that I need to keep close to the chest and build those relationships, and then we've got our borrowers. And the best part about the broker is we get to bring folks together, and we've done 2 deals. We're going to do more in the future, and that just helps me with my job because I can go to my lenders that I've done 20 deals with and say I can rep this guy. He's solid. He stands by his performance. He's able to perform. Here's not only the REO schedule, but 2 different deals that we've worked on that he's turned it around. So those relationships run deep with us on the mortgage
Yeah,
bank.
yeah. That's even a nicer solid once you understand, like, because we stay in touch, and like we're gonna do this deal down the road. When we get to show like our refinance, dude, when you see my numbers, Aaron, on Eagle Village,
Oh, I'm excited.
oh gosh, damn, bro. So I mean, I've told my audience this probably on a podcast, but I want to tell you because I don't know if I think I've told you, but we were doing 195 total income, right? 195. Then the summer months come because they were doing 9-month leases, 165, 167. Then we finally get to our lease up. Now it's my staff, my team, 225, 225, 225. Dude,
You're the
that's like
player.
$30,000 in more income, right? Every month. Dude, that's like, so 30,000 times 12, 360 at a 7 cap, it's like 5 mil. Just right there. Just like, that's not even talking about what we've saved in expenses. We've saved money in expenses too. Um, all that yields sexy cash flow.
And
Sexy
that's
cash flow,
that's
dude.
how you make money in real estate too, right? Oh, and keep in mind and I'm sure you've talked about this, but that cash out refi, all that equity going in your pocket is tax free.
Amen to that, brother.
There you go.
Hey, there's nothing better than free, tax-free money. Because Uncle Sam wants his, trust me. But like, you find ways to not have to pay him. That's really the trick. So, um, guys, listen, Aaron, dude, I mean, lending's critical, right? How critical is it to have a lender? It's real critical, right? So, if my people want to find out who you are, how do they get a hold of you, brother?
Sure. Call me, email me any way you like. Again, name's Aaron Moll. It's Moll. I'm on Berkadia's website. Based here in Detroit, do deals all over the country. Student housing, conventional, really anything, office, retail, self-storage, kind of the whole gamut. But phone number's 231-360-1840, and email's aaron.moll@berkadia.com. So happy to help anybody.
Yeah, listen, I highly endorse Aaron. I mean, I think he's a true professional. It's hard to find really good lenders that care, right? I mean, it's like anything else, right? There's always good people, out there, and there's average people, and there's great people. And Aaron's one of the great people that you can work with confidently. That he'll really look at your situation and say, let's put a loan program product together that's going to best suit you and your needs and your exit and the whole holistic approach to what's going on. And that, my friend, is hard to find. Truly, it really is. Right?
I appreciate it.
Yeah. Thanks a lot. So listen, guys. Constructing your power team is one of the most important things you'll ever do. Aaron's a great asset for that, as well as having a management company, all those things like that. But multifamily, the ability to do multifamily starts with vision, and honestly, it starts with a dream, right? You have to make a choice of whether you're going to do this business or keep sitting on the sidelines. So if you're looking to take it to the next level and need a little hand holding, I recommend that you go to my website, kahunaboardroom.com. Check us out. We have a course that's $7,500. It is intense. We only do it 3 times a year. And next year we're only going to do it twice. Because why? Because Corey doesn't want to work so hard. Okay? And I only allow 35 people in it. So if that's you, take the time to get into the boardroom. Set your application. Either I or my wife will call you to vet you. We want to make sure you're the right fit. We don't just want to take your money. But it is a very high level course, and you'll come out there knowing how to do real estate. With that said, guys, if you believe it, you can achieve it, and your paradise is possible.